So let's start talking about MACD, moving average convergence and divergence, one of the world's leading forex and CFD technical indicators. Now, personally, MACD is my favorite indicator. It combines overbought and oversold. It gives you transaction signals as well as giving you divergence. It is one of the most complete and reliable indicators you can find in the marketplace. Now, it was developed, probably 40 years ago by Gerald Arpel, actually in the late 70s, and it's a momentum indicator. It will help you spot changes in the momentum of a trend and possible shifts in the trend. Now, it's referred to as MACD, which stands for Moving Average Convergence and Divergence. I actually like saying Moving Average Convergence and Divergence. It sounds really important, but most of us just call it MACD. The basic function of a MACD indicator is to discover new trends and help identify the end of current trends. Now, the MACD indicators typically are always placed at the bottom of a trading chart in a separate window beneath the price charts. But today, with all the charts, including the charts on our ETX platform, which I'll show you how to do shortly, all you do is click on the MACD tool and it'll drop it all on there automatically for you. So there is really no mathematical calculations you have to do, and there's really very little you have to do to get it on your charts. But you need to understand it fully before attempting to use its signals. Now, the MACD indicator is 4 steps removed away from price action. Now, the concept behind MACD is fairly straightforward. Essentially, it calculates the difference between an instrument's 26 and 12-day EMA, exponential moving average. So we're going to do this step by step on a chart. Now, I'm going to apologize to you now because it's a very boring, and I tried to find as many exciting ways to show you to do this, but it's a boring process. But you have to know where each one of these lines come from, because that way it helps you spot when you're getting false signals if you understand what the lines are coming from. Once you do this, you never have to worry about it again. So let's go over to a live chart and let's do this step by step together. So let me pop up a chart on your screen. Okay, so we're looking at the current Euro-US dollar 30-minute chart. For no other reason, this is just a standard chart I use for class. Now, we start with MACD by calculating a 12-period moving average, but an exponential moving average. Now, if you don't understand the differences between simple moving average and exponential moving average, you should come to our class on moving averages. But an exponential moving average actually gives a little bit more weight to current price movements. And it's calculated a little bit, it almost comes out the same as a general moving average, but because it gives a little bit more balance to the most current moves, it's a little bit more accurate. And Gerald Arpel developed his indicator starting with a 12-period and a 26-period EMA. Now, a lot of times you hear us say 12-day and 26-day because if you're using a one-day chart, that's what it would be. But in this case, we're using a 30-minute chart, so that 12-period EMA is 12 30-minute periods. But we don't have to do anything. I've got them set up for us. But all you just have to do is click on the indicator and tell it to drop an EMA. So right now, I've just dropped on the chart. You see the gold line. And that is a 12-period exponential moving average for the price of the euro. You can see it moves along steadily with price movement. And basically, they say a moving average helps take some of the noise out of the markets because price bounces around all over the place. But this is just where we start. Now, if we were just using this moving average, we'd be just trading moving averages and really not getting much help in making a trading decision. But we combine this with a 26-period moving average, which I've just dropped on your charts. in the blue line. Now, if we were to trade the two moving averages and trade the crossovers, which is a very popular strategy, we'd be simply trading a moving average crossover strategy, which is very simplistic and isn't so highly accurate by itself. But this is just where MACD starts from. So the first thing MACD does is we start out with these two numbers, okay, and these lines. Now remember, the lines are based on numbers. For each period, there's another number. The dots are put on a chart and they're connected together. So we start out with these two moving averages. Then what we do is we take the 12-period moving average and subtract the 26-period moving average from that number. So right now, we would take this yellow line, gold line right here, and whatever that number is, we would then subtract the 26-period moving average from that. That's not a hard calculation. That's one number minus another. And what we do is we take the difference between those two numbers and we drop them on the MACD chart down below. And that gives us what's called the MACD line, which is the blue line that we put down there. Now, if you notice, on the right-hand side of our charts, we start out with a zero line here in the center, and then we move up, and we can move up as far as you want or down as far as you want. But we start with a zero because whenever the yellow line or the gold line and the blue line cross each other, they would be the exact same number. So one number minus the exact same number would always be zero. So whenever the MACD signal line down below is at the zero line, it tells us that these two lines above are crossing each other. If it falls below the zero line, it tells us the 26-period moving average is larger than the 12-period moving average because you're taking one number and subtracting a larger number. So that's telling us the blue line is larger, so that would give us a negative number. When the gold line or the shorter moving average crosses above, that's going to give us a positive number, and it would be above zero. So this blue line down below is simply the difference of the 26 and the 12-period moving average. That's not so complicated, is it? But that's just the basic starts. Because now we have no need for these lines above at all. And they're not used, except the numeric value, for MACD. So we've removed them from our charts. And what we have below is the MACD signal line. This blue line is called the signal line. The signal line, it's called the MACD line. The MACD line is what? It is the 12-period EMA minus the 26-period EMA. And it is charted down below here, above and below the zero line. Well, that, again, doesn't tell us much. All that's really doing is giving us a visual representation of a moving average crossover. So we wouldn't need Gerald Arpel and this marvelous indicator to do any more for us. Okay. Basically, it doesn't give us much information. But the MACD moves on from there. The MACD line then takes the average, the 9-period moving average of this line below, this MACD line, and averages it together with a 9-period moving average. So we can see here we have a 12-period, 26-period, and a 9-period. So what it takes is gives us the 9-period moving average of this moving average line that formed the MACD. And so we would pop that under our charts. And so now that is put on our charts, and that is called the signal line. So we have the MACD line, which is shown in our blue right here, which is simply the 12 period minus the 26 period moving average. We then have the 9 period moving average of the blue line. This is called the signal line. Now, when this signal line crosses the MACD line, it gives us what we call transaction signals. We can refer to them as buy and sell signals, but they're really more buy and sell alert or transaction signal. They're telling you that there's an opportunity to buy or sell at this current price. So if the MACD line, or if the two lines cross and the MACD line crosses below the signal line, it's a sell signal. If it crosses above, it's a buy signal. But it's a buy alert or a transactional alert. It's telling, because you got to use other decision-making capabilities. It's only telling you there's a buy or sell opportunity. So what the MACD line is 4 steps now removed away from the price action. But MACD doesn't stop there yet. So from here, we had the last part of the MACD line on which is called the MACD histogram. And the MACD histogram is the difference between the MACD line, which is the blue line down here, and the MACD signal line. So this is the MACD line, the blue. The MACD signal line is here. And the difference between these two lines is plotted on what's called a histogram. Now that histogram will always be 0 when they're crossing over each other. So let's put the histogram on here. And now we have the MACD histogram. Now the histogram is a visual representation of everything that we just calculated coming down here to the MACD line. Now, when the histogram, and just for right now for class, I'm going to turn off these other two lines so they're not in our view screen at the moment. So the MACD histogram, when it's at 0 on that same 0 line over here, so whatever this MACD line is right at the 0 line, what's happening with those, the MACD line and the signal line that we just took off the screen? You know they're touching each other and crossing over because the two numbers are exactly the same. And when you subtract one number from another and they're exactly the same, the difference is always 0. Then the MACD histogram represents how steep that move is. The larger or the faster the signal line, the MACD line rises above the signal line, the higher the histogram will get. The lower the histogram is, the closer it is to coming closer together. Okay, when it falls below, it tells you the exact opposite. The MACD signal line crossed over the MACD line, and it's larger of the two, so it's a negative number when you subtract the two. So, and the depth of these valleys, or the peaks, tells you how steep or how big the difference is between those two lines. So let me put them back on our chart so that we can actually now look at those two lines and we can kind of see here where they're spreading. Let me get my marker on here for you. See here where they're spreading far apart? Well, what do you see? This is the MACD line and the signal line. Okay, number one, they've fallen below, so the MACD signal line is larger than the MACD line, so it's a negative number, and the gap is widening, so this valley is steeper. As they start to come together, the valley gets narrower. As they cross back over, we hit the zero line. As they spread and the MACD line gets larger than the signal line, it starts moving up in that direction. So technically, everything that we've done in all of these calculations, starting here with the moving average lines above the EMAs, and then putting them down here for the MACD line, the signal line, all appear in this histogram. Now, some of us, like myself, I trade directly from the histogram. I don't use any of the other lines. You can keep the lines on your screen. Okay. Moving average lines, like I said, above, you don't have any need for. And technically, you really don't have to have the MACD line and the signal line below, and you can use just a histogram, or other people, and it's up to your preference, can get rid of the histogram and just use the MACD and the MACD signal line. Now, this is just the bare bones. At this point, we're just simply learning how to put this on our chart. We haven't learned how to use it in our trading. Yeah, we talked about the crossovers being transaction signals, but that's only the first bit of MACD. But we have to understand what these lines are and where they come from and what we're looking at before we can start using these to interpret in our trading. So let's go back to my PowerPoint. Now, just so you know, you never have to do any of these calculations. All you have to do is come up here to the MACD under the indicators and find MACD on the choice and click on it, and it's going to drop it right on your charts exactly how it should be. You can also customize, if you want, the 12 and the 26 period or the 9 period, but then it's no longer by the standard rules, and you have to learn you have to test it yourself to how it's going to act and react. Gerald Arpel developed with a 12, 26, and a 9. If you want to use a 12, 32, and an 8, that's fine, but it's not going to be, they'll work exactly the same, but the calculations won't be the same. So you'll have to then determine how to use them in your trading. And like with mostly all indicators today, you can customize them. There's all kinds of gurus in the marketplace telling you, well, I use a 15 and a 47 day and an 8 day this. Follow my strategy and you'll make tons of money. Okay. They're all just trying to teach you to follow their God knows what. I always believe in following the way the indicator has been used for 30 or 40 years and then adjusting my interpretation to fit my trading, not changing the numbers. But again, the choice is up to you. So let's go back to the PowerPoint now. Okay, and let's actually, I'm going to take you over and show you how to put MACD on the ETX trading charts and how it's used on the ETX platform. And then we'll go back and talk about how to use it and use it to determine trades or interpret the markets and use it for your everyday trading. So remember, the moving average, convergence, and divergence indicator is both a momentum oscillator and a price-based oscillator. And it's one of the most reliable studies that we have. Now, it's called a lagging indicator. Now, lagging is not a bad thing. Yes, in English and in our everyday use, lagging is, he lags behind his school. His growth is lagging. It's negative connotation. But when we come to indicators, there are two choices, lagging and leading. One is not better than the other. Lagging indicators just simply mean they follow price and tell us when an action has happened instead of telling that an action might happen. Now, it is highly interpretive probability signals that are based on the differences existing between three moving averages and its histogram. While it is slower than momentum indicators such as stochastics and relative strength index RSI, if you are willing to sacrifice a little speed in exchange for safety, it is good at keeping you on the right side of the market at all times. Because if you follow the side of the indicator, and when the histogram, especially when it's moving up above zero, you should be trading on the right side of the market, which means you are trading with the trend going up. If it's down and below, the price is trending down, and you should be trading. Because there's a theory called green light, red light. And whenever you're looking to buy, your prices should be above your moving average and therefore in the green section. And because you should always be buying with the trend or selling with buying with an uptrend, selling with a downtrend. And even though a lot of people don't believe it, especially a lot of new online traders, statistically, if you follow that belief that the trend is your friend, you will statistically come out and make more trades more successfully. So it's a good thing to follow, and always make sure you're on the right side of the trend. So before we start talking about the 3 stories of MACD, let's go over and watch the presentation I have for you on using this on the MACD on the ETX platform. Okay, so as you can see, there are 3 stories that MACD tells. And there are 3 different ways that we can use this one indicator, which is great because instead of having to use a whole bunch of different indicators, MACD gives us 3 pieces of key information. It gives us crossovers, which we saw, and we call these transaction signals. It gives us overbought and oversold conditions, which is similar to what we get with stochastics and RSI, and that's telling you when the momentum of an asset is shot up way too high or way too low. And it also gives us divergence. Now, there's a lot of indicators that give us divergence. In fact, we have a whole class on divergence, but we can get divergence with MACD. So the first part of it is crossovers. And like I said, I refer to these as buy or sell alerts, or we can call them transaction signals. They are not instructions to you to go buy that asset now. They are simply saying, this is a buy signal. Open your eyes, do all your other strategies, figure out your risk management, your money management, and consider buying this asset at this point. So the basic MACD trading rule is to sell when the MACD falls below its signal line, or to buy when the MACD moves above its signal line. It's also popular to buy and sell when MACD goes above and below zero. Because what happens? Above or below zero on the histogram is what? Is when the lines are crossing each other. So when it goes above to zero and above, it's a buy signal. When it goes to zero and below, it's a sell signal. So either way, we can look at it when it crosses over. Because exactly at that crossover, it's also at zero on the histogram. Or a buy signal when it crosses below and up. Sell, sell, buy. So you can see, okay, you can actually see in here the relationship between the uptrend and the downtrend, the MACD histogram. You can also see the depth of the price movement, and also see that in the histogram simultaneously. But these are where it generates the transaction signals. It also generates overbought and oversold conditions. The MACD is useful as an overbought and oversold indicator. When the shorter moving average pulls away dramatically from the longer moving average, in other words, the MACD rises, it is likely that that asset is overextending and will soon return to more realistic levels. So you can either see this in the histogram by a very, very steep chart, or you can see it in the separation between the MACD and the signal line. And then lastly, it shows, and we'll go through this in a little bit more with when we're going to apply this to your trading. And the last thing it shows us is divergence. Divergence is when the indicator is moving in one direction while the price action is moving in an opposite direction. So in other words, if we look on our price chart, we see that this asset is falling. It's making lower lows. Now, if you don't understand the difference between lower lows, lower highs, and higher lows, you need to come to our class on, on understanding trends. But in a downtrend, prices are making lower lows. And in this case, you can draw a line across here, and we can see it's making lower lows, where our MACD line itself is making higher lows. In other words, it hasn't gone above zero. It hasn't gone over to 100. It hasn't gone to any direction. It's not important what numeric value is. We can see that it's making higher lows. It's moving up this way while price is moving in the opposite way. The price and the indicator are diverging. Okay. And that is divergence. Divergence is very helpful. When we get divergence, divergence is not giving us at any time a signal to buy or sell. If you're in the market and see divergence, you might want to think that the trend is about, whichever way you're going, the trend is about to end or the trend is faulty and want to get out of the market. But when you've had divergence and then you get a price breakout, then you have the two pieces together definitely give you a buy signal, because this is telling you that the downtrend is over. And when you get the buy signal across and you get a breakout, that is then a double kick in the butt saying to buy. But that doesn't mean that you can ignore your risk management and all your other skills. Here we see just the opposite. This is bearish divergence, where price is moving higher, making higher highs, where the indicator is making higher lows. Lower highs. So as you can see, they're diverging from one another. Okay, this is called bearish divergence. It's the opposite of the bullish divergence. So remember, the MACD histogram, or the MACD line itself, is an indicator of an indicator. In fact, MACD is also an indicator of an indicator. This means that the MACD histogram is 4 steps removed from the price of the underlying security. In other words, it's a 4th derivative of price. So remember, the first derivative in the MACD is the 12-day EMA and the 26-day EMA. Remember where we put those on the price chart. Then the second derivative is when we're subtracting the 12-day EMA and we're subtracting the 26-day EMA from the 12-day EMA, which gives us the MACD line, which is that blue line we put on the bottom of the chart. Then the third derivative is we're taking the 9-period EMA of the MACD line, which is the blue line, and averaging it out as a 9-period and putting that on our chart below as our second line, which is called the MACD signal line. And then the fourth derivative is the actual histogram, which is the MACD line less the MACD signal line. So it's a lot of massaging of data, which is a good thing because what it's doing is giving us something. It's taking all the data, and all the data is price action because all of it's based on the price. And it's moving that price and analyzing that price 4 times away to give us some indication of what it's doing. So let's talk about how, or let me share with you a presentation about how to use this in your actual trading and how to apply MACD to make trading decisions, because that's what we all ultimately want to do. So remember, or you should always be aware that when you're using MACD in your trading, that you can get whipsawed in and out because MACD is not taking in at any time the structure of the move. Okay, it's giving you overbought and oversold conditions, it's giving you divergence, it's giving you crossovers and transaction signal. But when it tells you it's a buy signal or it's generating a buy alert, it's not telling you that asset, and this is why I keep trying to say it's a transaction signal, not really a buy signal, because it's telling you that you could think about making a trade going up, but MACD doesn't ever tell you how far they expect that trade to move. So when a price is moving quickly or when it's range bound, it can give you many buy and sell signals or alerts that are false signals or that don't give you enough move in any direction to make profit. It doesn't even cover your spreads because, yes, if you look at the chart, it was very accurate. If you would have bought exactly when that signal was generated and you would exit at the right price, you might have gotten out covering your spread in a point or two, but you're never going to get in that close because it's going to give you many buy and sell signals. So you've got to be aware of this. So traders should be aware that the whipsaw effect can be severe in both trending and range-bound markets because relatively small movements can cause the indicator to change direction quickly. The large number of false signals can result in a trader taking many losses. When commissions are factored into the equation, the strategy can become very expensive. Another MACD drawback is inability to make comparisons between different securities. The MACD indicator, though, is the most popular tool in technical analysis because it gives traders the ability to quickly and easily identify the short-term trend direction. And the nice thing about MACD is it will work very well for us who are virtually day traders when we're online traders trading CFDs. And if you're using a 5-minute chart, a 10-minute chart, a 50, MACD works extremely well in short-term time frames, okay, which a lot of indicators we use but really don't work in very short-term time frames. The clear transaction signals help minimize the subjectivity involved in trading, and the crossovers, the signal line, make it easy for traders to ensure they are trading in the direction of the momentum. Very few indicators in technical analysis have proved to be more reliable than the MACD, and this relatively simple indicator can quickly be incorporated into any short-term trading strategy. So if there were ever a quest in the world of investing on par with the search for the Holy Grail, it would be acquiring the ability to spot trend changes. Okay. Now remember, even if you're not using MACD to enter the market, if you're in the market and you spot the market moving against you, it can get you out of the market with a profit or without much of a loss, because when you can spot those trend changes quickly, you can protect yourself. There are many ways investors attempt to do this with varying degrees of success, but a common trend tracking tool is the two-line moving average convergence and divergence. This tool measures an asset's momentum and can aid investors in spotting changes in market sentiment. Momentum in charting is similar to the momentum in physics. If you throw a ball in the air, it will ascend at a slower and slower pace the higher it projects. After monitoring the changing momentum, a person can determine that ball will stop climbing, change direction, and descend. And MACD will help us see when that momentum is starting to wane. It won't tell us exactly what point it's flipped over, but it can tell you it's waning and about to start descending or ascending. So just like in physics, momentum changes occur before the price of an asset changes. So MACD can be used in many ways. The strength of the current trend can be measured by channeling the MACD. Okay. It will help you in all of your trading, and it's not a very complex, difficult indicator. So remember, like life, trading is rarely black and white. Some rules that traders agree on blindly, such as never adding to a loser, can be successfully broken to achieve extraordinary profits. Now, MACD sometimes can be used without even looking at price action. Some traders actually will take their eyes away from price action and just trade exactly when MACD gives them an indication to trade. Now, this isn't such a good thing because you're not applying risk management, money management tools. But there are many ways that you can incorporate MACD into your trading. But remember, just keep calm. Take your time. MACD is a great indicator. Like I said, it can replace RSI and stochastics for you. It's very simplistic to use. And before you know it, don't start trading with it. Don't start making decisions. Watch it, use it, put it on the bottom of your charts, and start noticing in your own, circling when there are crossovers, circling when there's divergence, and start getting your eye accustomed to using it and using it with the price action above. And you'll find it can help you make very smart decisions. And on that note, I'm going to say goodnight to everybody. Thank you very much for joining us, and I'll see you on Thursday. And have a great trading week. And keep your close eye on Brexit. I don't know what happened since we've been in class, but the pound and the FTSE should be going crazy this week. And remember, volatility is a trader's friend. Prices go up and down. We can make profit in both directions. So just be able to predict what is happening could be successful for all of us. Have a good night now, and best wishes.